about Yellen and Summers for a second.
Yeah.
And what I want to focus on in particular is the debate of the moment, this idea that financial markets have passed judgment on the probability of a Summers nomination and that they're pricing Treasury yields higher in anticipation of that. Do you buy into that argument?
Not at all. I think, there's two ways to try and figure out the difference between the two candidates. One would be you go and ask people trading in markets, ask them what they think. The other is watch how they're actually trading. And we saw a very big shift in the odds. Essentially, 3 weeks ago, markets believed we had a Yellen Fed chair. 2 weeks ago, they thought it was Larry Summers. Right. And so it's an as-if experiment, and you get to see how the markets responded, and the markets basically yawned. So as the odds of the two have gone up and down, financial markets appear to be completely unconcerned.
I don't buy the idea for a moment, though, that markets don't care who the Fed chairman is.
Right. So the point here is Obama's got what appears to be a list of two, maybe three if you include Don Cohn as well. So what the markets are responding to is the differences among the three on the short list, right? And so essentially the markets are roughly indifferent among the three on the short list. If there was the possibility of a dark horse, an extremist candidate, for instance, something like that, you could definitely see a lot more attention around this. So the claim here is not that the Fed chair doesn't matter. The claim here is what we know about the existing candidates is sufficiently similar that the markets haven't been reacting to the news.
Okay, so even if you don't agree with this notion that markets are, so to speak, pricing in a Summers nomination, do you agree with the idea that supports it, which is that Summers, given his criticism of the efficacy of the bond buying program, quantitative easing, specifically as it concerns mortgages, would lead him to taper faster than Janet Yellen?
I think we just don't know. And I know a lot of I know Janet, I know Larry, I know a lot of their friends. I think a lot of the pontificating is making stuff up, frankly.
Well, that's a provocative statement.
Yeah.
When in doubt, make it up.
Well, people are paid to do that sometimes.
I guess that's true, but not you. What right now, or what, not right now, let's talk about what's likely to happen over the next few months.
Yeah.
At some point, whether it's in the Fed meeting in a couple of weeks, or the one after that, we're likely to see some commentary, if not a decision, on what to do about quantitative easing.
Absolutely.
In that climate, what's going to be a bigger drag on the economy? The fiscal situation, because the budget has yet to be sorted out,
yes.
Or monetary policy?
Overwhelmingly, the biggest drag on the economy is going to be fiscal. Through the next year, it looks like fiscal policy is going to knock 1.5 percentage points off GDP growth. Putting that back into English, it says if we weren't cutting back fiscal policy, we'd be having a healthy recovery right now, and we're in the midst of a healthy private sector recovery being held back by cuts to government spending.
So how dangerous, then, in your mind, is the battle that is looming over the budget, the possibility of government shutdown? All of these things could happen before the end of this month.
Yeah, this is Washington, isn't it? Every year we sit around and we fret, watching for them to screw it up, and right at the last moment they don't. But if you play chicken long enough, maybe we go off the cliff.
And what do you, look, You're not a policy analyst per se, right? You're an economist, but at this point, can you gauge the odds of that happening? Are you seeing that as the likeliest scenario?
So my friends on the Hill, those who are closer to politics, tell me we should be very worried. By the same token, at this time every year, they tell me we should be very worried. This is a town with a lot of worrying. We've got a history of getting it right. But these are games that by the same token, I think these are games we really shouldn't be playing. And so I think people in the market should be extremely aware and following this very closely. It's one of the biggest risk factors out there.
Quick question before we go, Justin. Bill Gross of PIMCO wrote today that there is a real danger that we have allowed the credit creation, or that the credit creation cycle is running out because quantitative easing, people are just far too hooked on this idea of monetary support from the Federal Reserve and other central banks around the world. Do you agree?
If the economy's sick and lower interest rates get people to invest, that seems like a useful cure. And anything beyond that seems a little bit too complicated for my taste.
But if the Fed begins to pull back and other central banks begin to pull back?
So monetary tightening this is a bad time for fiscal tightening. It's a bad time for monetary tightening.